Good evening and welcome to our today's session. We are doing our first topic for advanced taxation. We are covering a topic relating to taxation of business income. And I just want to give you the overview of the taxation, basically when it comes to the businesses, the business income. And we are going to be looking at it on how the International Financial Reporting Standards normally disagrees with the Income Tax Act. So in this case, most of the key things which you are going to be looking at is that the examiner is going to be providing you with an income statement, which is already prepared by specific accountants. But you have now to do some tax assessments, or you do tax investigation, where we have to be checking on what are some of the expenses which are being used in the computation of the taxable income. And in real case, they are not recognized by the Income Tax Act. I remember at the beginning of the year, we had some new changes regarding to how we are going to be displaying, or how we are going to be doing our input and outputs in the computation of the VAT payable and refundable. So in that case, it is mostly, when you're looking at it, in most cases, you'll be able to find that the KRA is developing a system whereby we are going to be auto-populating our expenses and incomes in order that to avoid a lot of inconsistency in filing our returns. So in this case, it means that the invoices which are not having the control unit invoice numbers are not going to be recognized by the Revenue Authority when you are filing your returns. And if you are going to be using them in filing the returns, initially you are going to be seeing them going through, but nowadays they are plugging them out from the ledgers which you have already used in the computation of the taxable incomes and so on. So in this case, we are going now to be, when we are learning your taxation throughout, we normally discuss about we normally do some adjustments of the taxable incomes through the examination of the financial statements. And the reason is into which you are doing so is to allow or to check on the allowable expenses. And in this case, we are calling them genuine expenses, which are being deducted. If they were not deducted, we deduct. All disallowable expenses have been ignored. If deducted, we add back. The reason is why we are adding back is because when you look on the initial computations of the financial statement as given by the examiner, and then down there they are giving you some narrations, the examiner is trying to bring a sense of you understanding or seeing whether these disallowable expenses, which were used in the computation of the taxable income, right? They reduced the total amount, the income. They reduced the total income, and that is why we are saying, because they are not recognized by the Income Tax Act, right? We should be adding them back, right, to increase the taxable income. So when you are starting majority of the question under taxation, we normally pick the income or the loss, the taxable income or loss, and then we are going to be doing our adjustments as we move on. Now, when you look on number 3, we are saying all the taxable incomes have been added. If not, we are going to add, and I will be able to show you that later. All non-taxable income have been excluded. If included, we deduct, right? So in this case, you know very well that when you are dealing with the aspect of the incomes, there is the loss of sale. We normally discuss about the insurance compensation of the stolen goods and so on. But that kind of income that is being recognized by the tax is the one that relates to the stock of a certain organization. Hautaniambia uliibiwa motor vehicle, which does not relate with the business. Are we dealing with the business of matatu? Na sisi tuna transport goods, you see. So we have to be looking at the specifics, and that is where you normally see under the compensation of the insurance companies when they are doing the compensation. They have to be looking at the risk that your asset is being exposed into. Now, I will be able to explain that further. The financial statement has been prepared as per the requirements of the income tax. Then all the non-business expenses have been excluded, even included. We are going to be doing our deductions. Now, sorry. Now, according to the Act, this is the Income Tax Act. According to the Act, we have said an income is either taxable or non-taxable. Those are the terms which I will be able to use, right? Number two, an expense is either allowable or disallowable. So when we talk about allowable expense, it means it is an expense which is genuinely relating to the business. So what are some of the taxable business incomes? And we are saying they normally include, number one, the proceeds from the normal operations, which are the transactions of the business. Zile umeuza, kama uko na kiosk pale, unauza unauza mafuta, unauza nini pale ndani. Those are the proceeds which you are talking about. Those are the kind of revenues which you are generating from the business. Now, we normally have some discount receipts, the insurance compensation of revenue items. In this case, we are talking about insurance compensation on capital items. We are discussing about the fixed asset we are saying is an non-taxable income. It should, however, be adjusted for under the capital allowances. So when you're looking on the fixed asset, I have said that any income which you are going to be checking there, right? The income that I will be able to sell my car, that income doesn't relate to the business, and we shall be able to look on that grounds of analysis. Now we have number 4. We normally have the foreign exchange gain, provided it is realized. You see there is a condition which is provided in that sentence, provided it is realized. So in most cases, an examiner is going to be giving you a foreign exchange gain, full stop, right? A foreign exchange gain without anything else. So it is upon you to make an assumption. Some students will say it is unrealized. If it is unrealized, it means it is an untaxable income. But if another student makes an assumption of realization, it means it is a taxable business income. Now, we have a foreign exchange losses is an allowable expense if realized. And those are the assumptions which I want you to be making in an exam. But we shall be able to check on that, because from now henceforth, it means the business income normally forms a basis of understanding of taxation. From now to the end, you will be able to use those terms: allowable, disallowable, taxable, and taxable throughout mpaka tumalize taxation. But we have some things which we need to put straight. Number one, in an exam, you'll be able to find that an examiner is talking of the bad debts. When you're talking about the bad debts, I just want to demonstrate about this. So when you're discussing about a bad debt, let me share my board here. Where's my board now? It's here. Now, when you're discussing about this aspect, we are talking of a bad debt. Bad debts. Yeah. Here we are discussing about a bad debt, right? A bad debt here. So we are doing taxation, taxation of business income. Taxation of business income, right? Now, we are discussing about a very simple concept here, right? A concept of bad debts. A concept of bad debts, right? Bad debts in this case, I know when you are doing your financial reporting, and this is where now the difference starts. When you are doing your financial reporting, it doesn't separate the bad debts, right? We normally write our bad debts. But when it comes to the taxation, the bad debts are normally categorized into, we have general, and we normally have specific, right? Now, when you look on these, we normally have two things here, right? Your general bad debts might increase or decrease. They might increase or decrease. When it comes to the specific, the same, you do the same analysis. This one might increase or decrease. They might increase or decrease. Now, the most things which you are supposed to be understanding here, when they increase, how do you normally treat it as under taxation? So if there is an increase, right? If it is an increase, an expense. So in this case, we can say this is a disallowable expense. It is a disallowable expense. I think you can be able to see up to that point. Now, if they decrease, we are discussing about the general. These are non-taxable. They are normally called non-taxable incomes. They are normally called non-taxable incomes. If they are going to increase, right, that is a disallowable expense. And if they are going to decrease, is an non-taxable income. But what about the specific? The specific is the one which is recognized by the Income Tax Act. Now, in this case, if they increase, if the bad debt for the specific increases, this we talk about, it is an allowable expense. It is an allowable expense. It is an allowable expense. But what about if it decreases? What normally happens if it decreases? This is what we call a taxable income. A taxable income. That is how we are supposed to be analyzing your, that is how you're supposed to be analyzing your bad debts. That is how you're supposed to be analyzing your bad debts. That is how we analyze our bad debts. I can see that you're not able to see it clearly. Right. We'll be able to make your analysis in that manner. That is how the bad debts are normally analyzed. That is how we analyze our bad debts. Let me just see whether I can bring it closer a bit. But can see everything. Just lies. Okay. Now, that is how we normally analyze the bad debts, right? Now, from the analysis of the bad debts, it is very critical from the notes which you are going through here. From the analysis of the bad debts, that is why you can see here, we are saying if the general bad debts now increases, that is a disallowable expense, right? And we normally add it back if it is part of your expenses. And if an examiner has put the bad debts there with no notes in the additional information, nothing. Now, it is upon you now to make your assumption, right? Some students, they may be able to find there because you have to be putting it as an entry. So you say, if it is a bad debt now, if it is a bad debt and it has an increase, now we are going to be adding it back. A certain student will say that is a general, right? Another one will be able to say it is a specific. So that is an assumption you do. And every student normally gets that answer correct. Now, when you have some decrease, it is an untaxable income, right? We deduct it because it has already increased the total taxable income. But when it comes to the specific bad debts, we are talking about the increase and the decrease. We have allowable expense and then we have the taxable income upon other analysis. I will be able to teach you as we progresses. But we are saying a debt arising due to trade are allowable against the taxable income if written off, but when recovered, they are taxable. Now, provision for bad debts, right, are not allowed for tax purposes, right? So in this case, I can be able to put a point there because I can see that you might not be able to understand it. Let me put a disclaimer here. I can be able to say, okay, so in this case, there is an aspect of saying NB, right? NB. Because you know we are discussing, when it is the bad debt, we are going to be discussing about the provisions. But let me put an NB here for better understanding. We say all the provisions are disallowable expenses. All the provisions are disallowable expenses, except the provision, the specific, it should be the specific provision. It should be the specific provision for bad and doubtful. Right? For bad and doubtful debts. This is the only, when you look at it, the specific provision for bad and doubtful debts, it is the only allowable expense. But all any other provisions are always disallowable. They are always disallowable expenses. You need to be taking note on that. You need to take note on that. Now, when you look at it, this is number one here for understanding. Number two, we need to be discussing some things. I'm hearing some accountants putting in place. We are talking about debit notes. They are normally called the debit notes and credit notes. We have the debit notes and credit notes. Debit notes and credit notes. And when you look at it, we say debit notes correct another charge, right? Debit notes correct another charge, while credit notes correct an overcharge. And we say communication is always from the seller, hence debit notes received, right? Debit note received increase your purchases, while debit note issued increases sales. So in this case, it is very simple. When you're going to be doing incomplete records is when you are going to be getting a problem regarding to the debit notes and credit notes, right? Let's now talk about, we have debtors account here. We have our debtors accounts looking like that. Then we have creditors. Creditors account there. It is there. It looks like that. You know very well, you normally start with the balance brought down, which you are putting in here. Then we have the balance carried down, which you put it there. The same applies when you come to this side. We say the balance brought down, we put it here. While the balance carried down, sorry, the other way. Sorry for that. The balance brought down, we put it there, it's on the credit side. While the balance carried down, we put it here. Sorry. Now, we have said, when we have the debit note issued, the debit note issued now, debit note issued, we put it here. Then we have credit note issued, reduces your sales, we put it there. And these things go against, by the way. You can see this is a sale. So when it goes to the purchases, unaona hii debit note iko hapa. What happens on the other side, right? When it comes on this side, the debit note received itakuwa on the credit side. The debit note received itakuwa hapo. And that is where we have said it normally increases your purchases. It normally increases your purchases. Then the credit note received unaweka hapo. The credit note received unaweka hapo. Wakati unakuja hapa ku calculate your purchases, they are normally called credit purchases. Zinakuanga a balancing figure. That is a balancing figure. Then if we were looking on the credit sales, zinakuanga on this side. And that is where we are saying they are increasing your sales. This is what is your balancing figure. Hii tutasoma yote wakati tutafika on the incomplete records. Very interesting area of consideration. You will be able to understand it more and much better. That is how we deal with the aspects of the credit and debit notes, the credit and debit notes. I think in that point, you are able to understand. These are just basics. That is why I said, let me today capture the basics, and then tomorrow you can be able to do, our illustrations. Now, once we finish doing so, once we finish analyzing to that point, I just want to go to number 3 of the analysis. Those are the areas that first you need to understand before we engage ourselves in doing our illustrations. Number 1, I said it is our bad debts. Number 2, I said it is the debit notes. Then number 3 now, I want to look at what normally happens to the opening stock purchases and closing stock and sales. Let us go there. Right? These things, once you capture them, and then you come across a question relating to the taxation of the business income. Utakuwa tu kwa mteremko unasema, these are the very simple things. Very simple things. Now, let me show something else here. Just want to show you something here. I want to look at the behaviors of the opening stock. Number 3, we are talking about opening stock. We are talking about purchases, closing stock, and sales. And sales there. These are the things which, for example, you temper with them when you are preparing your income statements. They are going to be having different behaviors on how the taxable profit or losses will be looking like. Now, we are saying, when you look at it on this, you say the opening stock. The opening stock and purchases. The opening stock and purchases have an inverse relationship. I will demonstrate this inverse relationship. They have an inverse relationship with profits. They normally have an inverse relationship with the profits. That is, we are saying when they are overstated, when they are overstated, right? Profit is understated. Profit is understated. The profit is going to be understated and vice versa. So you see, this opening stock and the purchases they have inverse relationship with the profits. So when you overstate them, right? When you increase the figures, when you do the errors of the double entry, right? They are going to be having some behaviors in terms of the profits. And that is why we are saying that our profit is going to be understated, is going to be understated. Now, what happens to the other part of it? We are saying we normally have closing stocks. We normally have closing stocks and sales. Closing stock and sales, we are saying they normally have a direct relationship. They are having a direct relationship with profits. They have a direct relationship with profit. That is, when they are overstated, right? Profit is overstated. Profit is overstated and vice versa. So let me demonstrate right now. Let me demonstrate about this. Very simple. Now, when you're looking at, let me talk about the correct, right? The correct gross profits. The correct gross profit. So I have only 2 columns here. Cash shillings there. Now, let's start with sales. For example, if my sales is 100, right? We talk about the cost of sales. We start with the opening stock. Opening stock of 50. Purchases of around 20. And then we have our closing stock. Our closing stock around 10. Now, in this case, I can see we have 60 here. So what is your gross profits at the end of the day? You find your gross profit is 40 shillings. Your gross profit is 40 shillings, right? Now, what about if they are overstated? Let me talk about overstated opening stock and purchases. If you are going to overstate them, or let me talk about, you can overstate or understate. It's upon the decisions. It's upon how the question is being drafted. Mine is just to show you how it affects your gross profits. So in this case, remember we have only two columns here, and our sales will be remaining at 100. So if we are going now to be overstating the opening stock and purchases, right? What will be the effect of the gross profit? So in this case, we have our cost of sales there. So we have our opening stock. Badala ya opening stock kukua 50, let it be 60, right? We have our purchases. So how much is the purchases? Our purchase is 20. Can we be able to put them at 25, for example? Then we have our closing stock. Our closing stock now remains at 10, right? This is 85.75. So what is the gross profit? We say our gross profit now is around 25. So you can see, if you are going to be overstating the opening stock by 10, and then also we come across the purchases we increase by 5 shillings, the effect of the gross profit, it means it will be understated. And that is why our point here was saying the opening stock and purchases have an inverse relation, because when they are overstated, profit is understated. And you can be able to see our profit now is understated. The profit is understated. Now, let us come to the overstatement. Overstated closing stock and sales. What normally happens here, right? What normally happens when we are going now to be overstating the closing stock and sales? Very simple here. Very simple. So in this case, hapo nakuja waniambia, rather than our sales being 100, now we are overstating the sales. So we say our sales now, we can put it at around 110. Now, the cost of sales comprises of the opening stock. The original opening stock of ours was 50. So in this case here, we have 50. Now we have our purchases. Now, when you look on the purchases of ours, is 20. So we put the original figure. Then we have our closing stock. So the closing stock now, we have said we are going to overstate it. Rather than being at 10, and we put it at 20. Sorry. Now, what normally, what is the behavior of the cost of sales? For example, here is 50. The gross profit of yours will be around 60. Right? Will be 60. Will be 60. So this is what we are discussing, and we are saying if they are going to be overstated, the profit of yours is going to be overstated. The profit is going to be overstated. That is the differences in the analysis of these points, and they are very crucial when you are dealing with the when you are doing the aspects of opening stock, purchases, closing stock, and sales, and the sales. That is how you look at the analysis and the effects which it has. Now, let us proceed. Let us proceed. We are saying here, we have very good notes there for analysis. Number 3 here, we are saying when all assets in a wear and tear allowance are disposed at a profit, the profit is normally called the trading receipts, right? If the business is continuing, or a balancing charge, if the business is ceasing, such profits is a taxable business income, Those are the things that you're going to be looking at when you are selling the property. For example, we are selling one of our assets, and the business is continuing, that is our trading receipts. But if we are going to be liquidating the business, that is what we normally call the balancing charges. Now, that is very simple for understanding. The other one we are talking about, even all assets in a WTA are disposed at a loss. The loss is normally called the trading loss if the business is continuing, but a balancing deduction if the business is ceasing. Such a loss is an allowable business expense. Now, we are going to note that gain on disposal stroke proceeds from disposal of assets is non-taxable income, while the losses on disposal is a disallowable expenses. Those aspects of assets, it doesn't have any importance right now. In a question, we normally just quote them. Now, we are looking now, because there we were analyzing the taxable business incomes. Right now, we should be looking at the allowable expenses, right? So the expenses should be strictly related to the business. If not, it will be a disallowable expenses. Now, some of the expenses of some of the examples of expenses used in business, they normally include, number one, we are talking about the specific bad and doubtful debts. Number two, any capital expenditure in clearing agricultural land or in clearing permanent and semi-permanent. Number three, we are looking on pre-trading expenses, that is, expenses incurred before the commencement of business, which are all would be allowable if the business was operating. Number four, we are looking at the legal cost. Now, in that case, when you look on the legal cost, it is normally categorized as the allowable legal cost and disallowable. Now, in that case, when you look on the allowable legal costs, number one, we normally have the preparing and renewal of business agreements, that is, business permits. Number two, preparing and renewal of employment contracts, preparing and renewal of lease agreements of up to 99 years, debt collection and settling of customer disputes, obtaining of financing by the issue of ordinary shares for public subscription. Then we have successful defense against an alleged breach of contract. That is where we are saying an examiner might be talking about defense against an alleged. It should be successful. That is a point to note. Now, we are talking about the legal cost in respect to floating shares for public subscription. And when you look at it, the only area where the business can be able to generate or to get revenue, it is through the issue of ordinary share to the public for subscription. Any other way, it is not allowed under the Income Tax Act. Someone might be telling me that Paul was able to come up with 100 million to purchase some preference shares from the company. That under the Income Tax Act is a disallowable. It is not an allowable income to the business. Now, or obtaining loans from the banks, the fees to process those loans, among others, those are disallowable things. Now, let us look at disallowable costs. One will be preparing and renewal of a lease of more than 99 years, transfer of property, that is land building, motor vehicle, etc. Raising of finance other than issue of ordinary shares for public subscription. Then we have the preparation of partnership deeds and MOA. Those are the costs of starting a business. Then we have the breach of contract. Those are unsuccessful. Then the last one, we are talking about the court fines and penalties, right? The other allowable expense includes expenses related to structural alteration necessary to maintain existing rents, entrance fees or annual subscription. We have expenditure on advertising about business, that is to promote the business, amount realized foreign exchange losses, amount of balancing charges, any donation to a charitable organization which is registered. Then we have the club subscription paid by the employer on behalf of employee. These are the things that we are supposed to be using mostly in the questions, which we shall be doing. Then we also have any amount of losses brought forward from previous years. You remember there before, for those who have done advanced taxation there before around 2022, we used to carry these losses for almost 6 years. Not almost, we used to carry them for only 6 years. Therefore, from the 7th year, we are not going to be considering those losses brought forward. But in this case, under the Finance Act 2023-2024, 2023 discussed about carrying forward indefinitely. It should be definitely now. We are going to be carrying that business definitely up to the point when the business is going to be generating revenues. Now, we have expenditure incurred on scientific research, whether capital revenue in nature. Then we have expenditure on a capital nature incurred for purposes of listing any securities exchange operating in Kenya. Number two, we are talking about non-allowable expenses. Expenses not wholly and exclusively incurred by a person in production of income. Number one, we talk about the capital expenditure of any loss of extortion of capital. And I remember I talked about depreciation disagrees with the Income Tax Act as per the International Financial Reporting Standards, recognizes the depreciation as part and parcel of the allowable expenses of the business. But when it comes to the taxes, we disallow it. Now, we have the capital expenditure by a person in the maintenance of himself or family. The other one will be any capital loss, which is recoverable under insurance control. Then we have any income of tax or tax of similar nature paid on income. Then the other thing here we can be able to brought to book, it is the premiums paid and an annuity contract, right? Those are some of the things which you'll be coming across in your exams when you are dealing with the taxable income and losses, taxable income and allowable expenses in that nature. Now, I would like you to check on the past paper now. When you look on your past paper right now, right, you'd be able to realize that there is one question which I can introduce to you. There is a question here which I can be able to introduce. For those who they don't have past paper, you can check on my loft. My loft, I said you can go to Play Store and you download it. My loft, right? Let's open the questions. How did we used to call our taxation there before? 1 minute. Looking on this question here. Advanced taxation, advanced public finance and taxation. Today you are just doing advanced. It should be question number 5B. Just want to show you how to do this. Who is reading for us? Should be Dawa Limited. Someone to read for us, please. Someone to read, please. No, someone? Paul, can you read? Do we have Paul here? Let me see. Bon, can you read for us? Boniface?
Which year?
2017 November, question 5B. It displays on my screen. be able to see? Joy?
Yes.
You read?
Dawa Limited provided the following income statement for the year ended that 1st December 2016. Turnover. Okay. Should I leave the information below and the figures?
Hello?
Yes. Additional information. The cost of goods includes opening stock valued at shillings 2.2 million, where closing stock was stated at shillings 2.8 million. The opening stock was overcast by 10%, and the closing stock was undercast by that percent. Legal expenses comprised acquisition of bank loan, settling customer disputes, preparation of memorandum of association, liquidation cost, patent rights, notices to defaulting debtors. General expenses comprised purchase of processing machinery, purchase of factory building, provision for corporation tax, purchase of furniture, directors' allowances, VAT appeal, credit notes received, delivery ban, debenture interest, bad debt analysis.
Bad debt analysis, sorry.
Okay. We are given the bad debt account. We'll then plot down specific provision, general provision, and then debit side we have the bad debt, the balance carrying down. Note 5, staff costs include staff development cost shillings 96,000, staff welfare expenses shillings 200,000, pension contribution shillings 1,480,000, and personal computer Kenya shillings 360,000. And advertising include non-signed Kenya shillings 129,000, depreciation of delivery van Kenya shillings 24,000, carriage out once Kenya shillings 9,000, and hire of billboards of shillings 86,000. Required a statement of adjusted taxable profit or loss for the year ended at 1st December 2016. Roman 2, corporation tax payable, if any, by Dawa Limited.
Thank you so much. When you come across this question, it's easy for you to get almost everything, because when this question comes, we normally start with a title. I will be able to show you how to write your title. Then we normally pick our net profit. We normally start our analysis with the net profit. I said you have to be doing the tax investigation here, right? We do some tax investigation. It is a topic at a certain stage of your syllabus. So the tax investigation also, you'll be able to see what normally comprises about it. Now, when you have this kind of question, you take the net profit and then you are going to be starting with the disallowable expenses, which you are going to be doing the adjustment, and you start with the additional information, right? You normally start with the additional information first. So let me just share my board quickly so that I can be able to show you how to do this. 1 minute, please. So let us proceed with our analysis. So in this case, I have said when you are dealing with these questions, the first thing that I need to do is to start with the heading. We are talking about Dow Limited. Dow Limited. We are being told to come up with a statement of adjusted taxable profit or loss for the year 2016. So we talk about 2016 adjusted taxable income, income stock loss computation. Utapanga vizuri pale kwa karatasi yako namna hiyo. Then you come up with the two columns here. Kenya shillings. Kenya shillings, You reduce your shillings to thousands. And then I'm going to be starting with the reported profit. We start with the reported. We start with the reported profits. So once you start with the reported profit, you pick the figure which is there, 75.21. 25.21 there. 75.21. Once you finish that, we said we add our disallowable. We add our disallowable expenses. And the disallowable expenses, we are going to be identifying them from the additional informations. So we start with the additional information number 1, where we are being told something there. There is something you are being told there by the examiner. The cost of goods sold include an opening stock which was valued as 2.2 million, right? While the closing stock was stated at 2.8 million, we are being told the opening stock was overstated. The opening stock was overstated by 10%, whereas the closing stock was understated by 30%. So what does this have effect with the net profit? When we say when we understate the opening stock, right? When you understate the opening stock, what normally happens with the when you overcast the opening stock, you reduce the reported profit, right? You undercast the reported profits. Then when you undercast the closing stock, it means also you reduce. So you add them back. So here let me talk about the overstated opening stock. The overstated opening stock there. So how much was the overstated? The overstated, it means the figure of 2.2 million equal 10%. Your 2200 is equals to 110%. We asked how much was overstated, which is 10%. So when you're analyzing it here, you say you take your 2200 times 10 over 110 times 10 over 110. So how much is this? Times 10 over 110. How much it is? Someone to use the calculator and give us the answer. How much it is?
200.
200.
It should be 200. Thank you. 200 here. Thank you. Now, what about understated closing stock? The understated closing stock will be how much? So the understated will be, we are talking about understated closing stock. We are being told it is understated by 30. So it means the figure given by the examiner is equated to 70%. So you say 2800 times 70, is this 70? No, this figure is 70. What about the 30? So it should be 30 over 70. 30 over 70, how much is this? 2,800. We are picking the figure which was under
1,200.
So we are not picking the whole of it or returning it to 100%. So these are around 1,200. 1,200, thank you. Then note number 2, note number 1 is done now. Number 2, we are being told the legal expenses comprised of number 1, acquisition of bank loan. We said the only way a company can get the money is through the issue of ordinary share to the public for subscription. That is the thing that we said. Any other form is a disallowable expense. 1, here we are talking about acquisition of bank loan. Acquisition of the bank loan is around 90, correct? Acquisition of bank loan is 90. Then we say the settling customer disputes is an allowable expense, right? The other thing we can be able to see there, it is the preparation of MOA. Preparation of MOA. So the preparation, we said, the expense which can be incurred before the business being put into use, those are disallowable expenses. So this one is 260. 260. I don't know why the system is now hanging. I don't know what is the problem now. The internet stable, everything is okay. Oh, the challenge there. Now, the other thing is the liquidation costs. The liquidation costs, they are disallowable expense amounting to 468. The other one, we have patent rights. You know what this means. The patent rights amount to 340. Then the other one, we have the notices to defaulting debtors. Hata naonanga organization mingi zinauliza tutatoa wapi? Where can we be able to get our tunaweza pata wapi the someone who anaweza tudai their code debtors there. Waende wakatudaishie. It is an allowable expense in the organization. Number 3, we have been told the general expenses which are comprising of number 1, the purchase of processing machinery. We said we don't need to take the cost of the assets. No, we normally look at where do they qualify in terms of the capital allowances. So every time you find the financial accountant ameweka pale the cost of purchase of any assets, tunairudisha kwanza, ni disallowed. So in this case, we talk about the purchase of processing machinery. The purchase of processing machinery, we have how much? 800. Then the other one, we are talking about the purchase of factory building. The purchase of factory building. The purchase of factory building amounted to 1,280. Right? The other one, we have the provision. I said all the provisions are disallowable expenses, except the provision, the specific provision for bad and doubtful debts. That is one I remember I told you. So this one is a disallowable expense, right? So we are talking about the provision for corporation tax. The provision for corporation taxes amounted to 394. 394 there. We have the purchase of furniture. The purchase of furniture amounted to 360. Don't mind, I will be able to look for alternative network. Now, the other thing will be VAT appeal. The VAT appeal now. The VAT appeal amounts to how much? The disallowable expense, 120. The other one, we have the credit note received. Najua now, you can make your own assumption. You say, the credit note received, relates to what? Relates to the fixed assets, which we have here, right? The credit note received relates to the fixed asset. Now utapata marks yako. So this one relates to the fixed assets. And if it relates to the fixed assets, It is a disallowable expenses. So in this case, ni ya pesa ngapi? You say 135. Another student atasema, this one is not part of this computation. So that is why I said that you might find that in an exam, umefanya exam nyinyi wote, but the answer they don't relate. We have delivery van. Delivery van amount to 720. Delivery van amount to 720. Hatujamalizana additional information. We have note number 4. When you look on note number 4, there is an analysis there. There is analysis there relating to the bad debts. We are being told that the bad debts are there. We have to check on whether we have an increase or the decrease. So when I look on the credit side, we have the bad brought down. On the specific openings, we have 240. Closure is 560. When you look on the general provision at the beginning was 180. The general provision at the end was 167. So it means there is a decrease there. If there is a decrease there, it means that one is a non-taxable income. We shall be able to deduct it later on. From there now, we can be able to look on note number 5. Note number 5 there. We are being told in note number 5, the staff costs which are basically put there. We have the staff development cost. I can be able to see majority of the accountants now are coming from the training from Mombasa. So in this case, that cost is an allowable expense, right? That one is correct. Then the other one is the network is letting me down. Now the other one is the staff welfare expenses of 200,000. We have pension contribution, which we are being given to the employees, but we have something called personal computers. Personal comps. That is a cost, you return it. So how much is the personal computer? 360. The other one we have advertisings now. The advertising include, number 1, we have neon sign. How much is the neon sign? We say our neon sign is 129. The neon sign is that normally qualify for capital allowances. I will show you how. We have the depreciation of delivery van. Depreciation of delivery van. The depreciation of delivery van, we have 24. Carriage out towards allowable expense, right? Then we have the hire of billboards. Utaambia companies which are hiring the billboards that you don't hire. It is basically used mostly for advertising the businesses. Now, ushamalizana additional information, and you can see my name, meshamalizana mpaka hapa. Right? Next time I will be having a very strong network. This one is bringing me down. Now, in this case, now we are talking about the less expenditures. We have the general expenditure being put there. We have impairment loss. Is that disallowable expense? Impairment loss. Impairment loss amount to 390. Right? We have bad debts. We have already analyzed them. We have advertising there. But we have something there can be able to see donations. Donation to disaster. The disaster funds amounting to 150. Yeah. We have property taxes, disallowable. Property taxes amounting to 136. The other one we have branch closure cost, disallowable. The branch closure costs amounted to 178. The branch closure cost amounted to 178. That is how you deal with the disallowable expenses. Allow me now here to group two things. We group the allowable. There are allowable expenses which were not deducted. Now we deduct. We together with non-taxable incomes. Because if the non-taxable incomes were added, sorry for that, if they were added, it means they increase the reported profit here. That is one. So in that case, it is very important for you to check on that. Non-taxable income, we deduct them, right? Non-taxable income, we are deducting them because already they are increasing. They increased our reported profit here. 1 minute to 1 minute, please. This one, we should not be experiencing it any further. One minute. So let us proceed. I said earlier that when we are dealing with non-taxable incomes, they have already been put up there. When you look on that income statement up there, we have been told there is an additional of other incomes. So those other incomes, which if they are non-taxable, it means they have already increased the figure for the reported profit. So that is why we are doing the adjustment here down. That is why we are deducting together with allowable expenses. So you can allow me to start with non-taxable incomes. Together, I will be able to start with the capital gain on sale of assets. Capital gains on the sale of assets, that amounts to 468. The other one will be insurance recovery. Insurance recovery of motor vehicle. The insurance recovery of motor vehicle is 450. The other one will be dividend from subsidiary. Dividends from subsidiary company. Subsidiary company. So the dividend from the subsidiary company is 942. The other one is the foreign exchange gain. The foreign exchange gain. Mwanafunzi nilisema hapa atasema it is realized. So akisema realized, it means it was a taxable income. It was a taxable income. It was a taxable income. I don't know why I'm getting this challenge. I said about the foreign exchange gain. The foreign exchange gain, I said that if, for example, it is, one student will say it is realized. Once you say the realized, it means you treated this right when you are computing the income statement, right? Another student will say it is unrealized. It means you treated it was non-taxable income. One will say realized, it means it was a taxable. Another one will be saying unrealized and put the figure here. Once you put the figure, it means it was an untaxable income. Now, the other thing there I can be able to see, it is the interest. It's normally called the interest on fixed deposits. On fixed deposits. So the interest on the fixed deposit amount to how much? The interest on the fixed deposit amounts to 300. To 300 there. Once you get the 300 now, it's very important now to look on the allowable expenses, which were not deducted. And which are these ones? Let me put them here. We talk about the capital allowances. These assets we have added back here, right? These assets we are adding back here. They are not supposed to be added back. They are not supposed to be deducted at the costs. You are supposed to be deducting the capital allowances. That is what is being required by the Income Tax Act. Na hii network ni kama itaki muelewe hii kitu. Okay. So that is the case now. You can see these elements here. we have, those are the sum of the assets. Those are the assets that we have. So you can be able to give them some capital allowances. I will be able to start with the processing machinery. Today, the processing machinery. So the processing machinery, they qualify for ID. The ID we discuss about the investment deductions. What is this now?